In a world filled with information, where do you turn to get straight talk about retirement, investments, and your money? Lock it in to the longest-running financial talk show in Arkansas, and let us help you build the bridge between information and application. Real financial change begins right here, and it starts with you.
It's showtime!
Coming up on today's show, it is often the elephant in the room that no one wants to talk about, but it's maybe the single biggest thing that could blow up your retirement income plan if you're not prepared for it. Stay with us.
This is the Get Ready for the Future show.
Hi, everybody, and welcome. It's another edition of the Get Ready for the Future show. Wherever you get us, whether it's online, on radio, or on podcast, we are glad to have you along for the next half hour or so. My name is Scott Inman, and with us today, John Shrewsbury, one of the founders of Gen Wealth, and Tony Conterno, who is our insurance specialist here at Gen Wealth, which kind of gives you a little bit of a preview of what this show is going to be about. The elephant in the room. We call it that, or I call it that. I don't know if everybody else at the table does, but it's something that it's the non-happy part of retirement, right? When you think about your retirement, you think about the things you want to do. You may think about the things you need to do and want to do. You don't think about the things that are going to happen to you. And that's where we are with long-term care. And if you've had a personal experience with it, guys, I think you're more sensitive to the need for it. But it's still something that's a cost, one way or the other, however you choose to address it, that people are sometimes, many times, I think, unwilling to really take on.
It's very difficult. It's hard to think about spending money on something that number one, you think, well, I may not ever need that. But secondly, it's also hard to think about a time in your life when you may be subject to the need for that. And so long-term care is a difficult conversation. It's one that we very intentionally have with our clients here at Gen Wealth because it matters. It's a big, big deal. If you're not prepared for long-term care and you have a long-term care event, the money's got to come from somewhere. So clearly there needs to be some thought process into this and some preparation put into it. And that's where your advisor here at Gen Wealth comes into play. And Tony is involved in a lot of those discussions because the need is very clear.
Yes, definitely, because it is an uncomfortable discussion, not only the financial part, but it's going to be a very difficult time in your life. And if you're not planning and including that in your financial plan, then you're going to be unprepared. And, what do you want? What do you envision that part of your life looking like? Do you want a relative help in nursing home? What's it going to look like for you?
Scott, I will be willing to bet that the vast majority of our audience spent their time last night watching television, maybe, trolling online to get election results because they're really concerned about the outcome of the election and what kind of effect it's going to have on their money and on their lifestyle and things of that nature, because we've been through a volatile time in the market, and they think, okay, we're going to change this, or what's happening here. And I will tell you that we're going to talk a little bit about the why it's almost a non-event,
right,
as far as the election is concerned in terms of your long-term financial independence, but something that nobody wants to pay any attention to, but really needs the kind of attention that you spent last night watching television is this long-term care issue.
It goes back to what you say all the time. It's not about the economy, it's about your economy.
That's right.
And this is a part of your economy, even though it's really not dollars and cents, although really it can be translated into that, but it's about your care. So when you talk about the election, we do want to take a moment to promote the Fastest Four, because you can get some real, John mentioned, we're going to talk a little bit about how the election results don't matter probably to the level that most voters think that it does, at least in terms of your money and your retirement and your investments. Now, certainly they matter in other ways, so we don't want to discount that. But we have a full 4-minute look, because it's the fastest 4 minutes in finance, at what's going to happen to the stock market. In fact, the last 2 weeks I've spent talking about the stock market as it relates to the midterm elections. If you haven't signed up for the Fastest Four, I want to encourage you to do that. It's really easy to do. There's two really easy ways to do it. You can do it from a distance off your cell phone by texting the word FAST to 501-381-5228. Again, it's 501-381-5228. Or you can just go to our website, getreadyforthefuture.com, and you can look for under resources the fastest four and just plug in your email address. We're not going to send you anything other than the fastest four video. It comes out on Friday mornings. We do it every week, and it's always market or money related. And for the last 2 weeks, we've been talking a lot about the elections. If you're listening on our radio show, it's going to be in this radio show too, so you could just stay tuned till the end. But what I wanted to talk a little bit about was just to kind of build out this point, because, John, you mentioned the fear. You mentioned the fear that people have if their party didn't win. And as we sit here and record this, we don't really know who's in power because 4 or 5 of the races in the Senate, anyway, are still outstanding. And the House is more than likely going to belong to the Republicans, but by what margin, we don't know. So does it really matter which party is in power? The short answer is
it really doesn't.
It doesn't. No.
There is a short-term effect,
Yep.
but long-term, the market doesn't care who the president is. The market doesn't care who's in Congress. Now, there are some monetary things that Congress does and things of that nature that do have some effect on the market, but by and large, a lot of this stuff is very short-term. And if you think about the time that we've been through in 2022, a 1 year period of time is short term. Mm-hmm. It really is in the grand scheme of things of your financial independence. And so there are things that I think you can obviously take away from the election. But here's one thing that we believe is really way more important than the outcome of the election, and that's the decisions that are being made at the Federal Reserve.
Yep.
The monetary policy that is going on in Washington has far more of an effect than the president or the Congress. Just look at it in 2022. There's been no big major legislation, no big policy decisions and things of that nature. But what has happened? We've raised interest rates half a dozen times or whatever it is, and rates have gone up, and that has had an effect. Rates have gone up because we had inflation. Now, obviously, clearly, when government interferes or intervenes in the economy, it does have an effect, and we saw that in COVID. Yeah. Now, you can debate whether that was good or bad, but what they did was they threw money at everything.
Yep.
And it created inflation. And so the Fed is responding to the creation of inflation to try to tamp down inflation. And what's going on right now, Scott, is that they're literally trying to play a balancing act between putting down inflation versus stalling the economy.
Right, without crashing it.
Yes.
Right, I equate it to the engine in your car. They don't want, if inflation is allowed to run wild, it's going to overheat the engine and it's going to blow.
That's right.
If they can create a soft landing, then we can come to the stop sign and be okay, and the engine will still run. And it's still debatable if that's going to happen. But even if it doesn't, it's going to be a blip on the radar in a long-term perspective. You know, one thing I want to point out when you were talking about the money that was issued, because that's what you're talking about, the COVID shutdown, the supply side really restricted, and then the checks that went out, the injection of money into the economy. And we did it more than once, but the first one was done under President Trump. And I think it's important, you know, the longer I am around, the more apolitical I get, but quite frankly, because it's a continuum. This is not a my guy did this and your guy did this. It is a cycle. It is an economic cycle. So the first decision for the money supply to be injected with money came in 2020 under President Trump. Now, President Biden did have more of that, right? And you could argue that he could do more about inflation from the gas prices side, right? You could argue that the restriction of oil pipelines and those type of things, but those are minor. Those are minor. What you're talking about are small things that could have an impact, but the economy is still what's in charge. And when you were talking about the monetary policy, John, I think of that line that is very common in our industry: don't fight the Fed. That's really what it is.
Yeah, clearly the Federal Reserve has a big influence on this. You think about the housing market and the fact that used to be you could get a mortgage for about 3.5%. Now I understand mortgage rates are somewhere in the 7% range. So that's huge. That's a big difference in the actual monthly payment on a 30-year mortgage. You raise the interest rate, you double the interest rate on that 30-year mortgage from 3.5 to 7. It makes a big impact. But here's the thing. I can remember when mortgage rates were 10%. 15%. You know, there were ridiculous numbers back in the late 70s and early 80s. And yes, I am that old. I can remember when that was going on.
I've read about it.
Well, yeah, I read about it. Okay. I'm just going to let that sit. But you know, the point is that a lot of this is relative. But what you've got to focus on is, does it matter to you if you had refinanced at 3.5%? Does it matter to you right now that there's a 7% mortgage out there? Nobody's pointing a gun at you saying you got to go refinance your house and that's going to raise your interest rate. So, you know, and obviously there's exceptions to that, but clearly monetary policy is a big deal. But what's even bigger is what you are doing in your strategy, in your plan, and are you being proactive in working with your advisor to be sure that your economy is going to be okay? And to get us back to our subject today, if you think about long-term care is an expenditure that the insurance for long-term care is an expenditure that you do need to make, but you do need to be having those conversations. Mm-hmm. And I think that's where we really need to bore in on the fact that I think a lot of people are almost being an ostrich and sticking their head in the sand thinking this is not going to happen to me, but there's a great chance that it is.
Yeah, and I think that goes back to what I said earlier about you want to focus on the happy parts of retirement. You want to think about the things you want to do, the bills you maybe need to pay, but you don't really want to think about that day where you may need long-term care. And the reality is, statistically, most of us are going to need it. Fewer than 1 in 30 Americans own a long-term care insurance policy, and only about 7% of adults over 50. So clearly it's not something we're interested in as a society in purchasing. However, common estimates say that about 50% of older adults will need long-term care at some point in their lives. For adults over 65, the odds shoot up to 70%. So if you've lived a long life already, those odds are greater that you're going to need care. So look at the dynamics of those numbers. About 7% of adults over 50 are leveraging a long-term care insurance policy, but that number is up to 70% for adults over 65 who are likely going to need it. So when you talk about this, Tony, look at the statistics. I think it's unique to the individual on why they're reluctant, but cost is oftentimes a big factor, and what type of policy. You know, the traditional long-term care policy, you are taking a chance by purchasing that, because if you don't need the care, you will have paid premiums for many years likely and not need it.
True. Yes. If you go off the traditional, which is based off of it's a health insurance policy, then if you survive and just hit hospice, pass away, then you get no proceeds from that policy. And I think statistics recently have said that close to 50% of people on a traditional policy never cash it out.
Yeah.
My grandma had one for 30 plus years, did great, got sick, hospice, didn't ever use it. And that's, kind of why we've looking at a life insurance policy, adding the long-term care coverage to it with a rider. And that way, we do pay a little bit more level pay, but then we are getting something out of it, and we can include that in your plan too as far as guaranteed money.
Yeah, I think that's worth boring down into, guys. Let's kind of take what Tony did and flesh out the details here. So 2 types of long-term care coverage. There's the traditional long-term care coverage, and as Tony said, there's the life insurance-based long-term care coverage. Well, what's the difference? Well, you can pay for the health insurance version of long-term care all your life, never use it, and you get nothing. You can take a look at the life insurance-based long-term care. You're going to pay a guaranteed level premium in that particular case, where your health insurance premium can actually go up, and will go up more than likely as more claims come in your age bracket. But the life insurance locks in your premium. So you pay for that, you know what you're going to pay. But here's the benefit. If you qualify for long-term care, then you have a set benefit that is there for you for a period of time on that life insurance policy. It is basically a prepayment of the death benefit. So if you have a $150,000 life insurance policy with a long-term care rider on it, you can access that $150,000 for long-term care purposes ahead of time before you pass away. If there's anything left on that policy, if you haven't depleted that $150,000 in our example, if you haven't depleted that during your long-term care stay, then the remainder of that $150,000 pays out as a tax-free death benefit to your heirs. So clearly somebody is going to get paid in this situation, either you through long-term care benefits or your estate, your beneficiary on that policy. It makes for a much more palatable way, I guess I would say, to be able to step into the long-term care thing. Although the initial premium on the life insurance, Tony, if I understood you correctly, it is actually a little bit more on the life insurance version than what the health insurance version is, at least from the get-go.
Yeah, and we're seeing it. The gap is closing because and if you have a traditional long-term care policy in your late 60s, that's probably still, the policies used to be a lot more robust. And at that point, you're kind of past the age of probably being able to get a life insurance policy. Right. But the gaps are closing. But you do, in 5 years, you could easily bypass traditional costs versus a life insurance policy as far as your premiums.
So John and I are former journalists, and it occurs to me as we're kind of vetting this out that this is the old who, what, when, where, and how, right? Yeah. That was the thing that we were supposed to solve for on every news story. Yeah. So that's really what we're doing here. We've described the who. We gave you the statistics of who's going to need care, and really it's a likelihood that we're all going to need it if we live long enough. The what, the problem is how do you pay for it? So let's I want to broaden that out a little bit more because we kind of dove into some policy talk, some insurance solutions, which may be for you, but let's talk about the silos, the three types of people who really have to address it in different ways. And the first group is someone with really no assets or very little assets. There really aren't a lot of options for them if they can't afford a long-term care policy, that they're going to have to probably rely on Medicaid. That's going to be their option.
Yeah, that is the state program, Medicaid, not Medicare. Right. Medicaid is the state program that is designed to take care of folks who can't take care of themselves from a financial standpoint. Now, qualifying for Medicaid is a challenge. It is difficult. You can't have any more than about a couple $1,000s worth of assets to your name in order to qualify for Medicaid. Now, there's a lot of details in that, but let's just use that, stipulate that it's about a couple $1,000s of liquid assets. So if you have a lot of money in your retirement account, you're probably not going to qualify for Medicaid. And you probably should use your retirement money to take care of you in your old age. But the way that you preserve those retirement dollars in case you live a long life or if you want to pass those on to your heirs is that you protect it with some type of long-term care policy. And essentially the long-term care policy forestalls more withdrawals out of your retirement account to be able to fund your long-term care so that money can continue to grow, continue to be there for you for other needs that you may have, continue for your spouse. If both of you are retired and there's no one earning a living in the house, usually there's one person that has a lot of the retirement money. This gets into a lot of complexity when you are dealing with this on an individual basis. But when you have a long-term care policy in play for the person that is needing the long-term care, then the solutions become a lot easier.
Yeah, and I think, Tony, too, it's really important to point out here when you're in that silo that you may need to leverage an insurance company for care, it makes sense, I think, to come in and have a holistic plan created with an advisor and with somebody like yourself to be able to see how it fits into the overall income plan. It may not be that someone needs a policy that will provide the full cost of care. It may be that they need a portion of it to layer into their overall monthly retirement income.
And true, in my prior career, we did long-term care, but we were blindly throwing darts, is a good way to put it. But, if you have the foundation income, I think is what we call it, and it's going to cover a decent amount, and we can leverage, your current day's dollars to buy a policy that will, maybe your spouse is going to need to live 15 or 20 more years or will, and we're, siphoning out one of our buckets or two of our buckets to cover your current expenses, then that can change up the plan that we're really working hard to do because we kind of ignored that part of it.
Yeah, let me kind of illustrate that in a certain way, because if you think about the way that we plan for retirement income at GenWealth, one of the things that we do is we create an income floor. That is a foundational income that basically takes care of your basic needs. So let's throw some numbers at it. Let's say you've got a couple $1,000s coming in from Social Security, and let's say that you've got another $1,000 coming in from some type of guaranteed income product that we've created for you. Now you have $3,000 a month coming in. That $3,000 a month is going to be there regardless of whether you're in a long-term care facility or if you're at home spending the money or whatever the case may be. So what you may need to do to cover that, let's say, $5,000 long-term care bill is you may need to redirect that $3,000 of basic living expenses to cover most of your long-term care need, and then use a smaller long-term care insurance policy to cover the gap. And so there are things like that that your advisor can work through in your situation. And I don't want anybody to take the examples that I'm using here today as being the gospel on how everything is, because obviously this is a very specialized, customized deal that we do for folks. But what you want to do is look at this from the most optimal way that you can utilize it possible. A smaller long-term care benefit means your premium is going to be smaller on that life insurance policy that has a long-term care rider on it. So it's got, with some, I guess, with some ingenuity and some engineering, you can get to a spot where you can cover the need without breaking the bank.
Yeah, I think a easy example would be if we've built a retirement income plan for a couple that is, let's just throw some numbers out there, say $6,000 or $7,000 a month, but they have assets that will support potentially another $1,000 a month that can be used. And of course, our plans for withdrawal from your assets are built on conservative rates of return, so we can have some peace of mind about pulling another $1,000 or whatever, $800, whatever it needs to be to pay the premiums on those long-term care policies. And when you mentioned the care and the cost of care, I did want to throw these numbers out. Because they are pretty astounding, and they go up every year. This is from a 2019 Genworth cost of care survey. That's Genworth, not Genwealth. People do get the two confused and interchange them sometimes. We don't here, but Genworth, it's an insurance company. The cost average this way from that study, assisted living could cost $48,000 a year. Home health aides, just bringing home health aides in, could be more than $52,000 a year. And a private nursing home, if you have to go there, a private nursing home care cost could be over $100,000 a year. I do think it is important to point out that those are national numbers, and I do think if you're in Arkansas or if you're in the South or if you're in a lower cost of living state, that could vary a little bit in your favor, but it's still going to be super expensive.
I got a real important point to make on this because it triggered it when you went through these different levels of care. You know what long-term care coverage really is? It's really coverage to help keep you out of the nursing home, because Medicaid doesn't cover anything but nursing home care. So if you have a long-term care policy, then you can actually stay out of the nursing home, which is what a lot of people really want to do, Tony.
Right, yeah, because the long-term care policy would kick in. You know, you're going to have their activities of daily living, eating, using the restroom, dressing, bathing, being able to clothe yourself. And if you've lost two of those, then that would allow you to use that policy. And most likely, if you've lost two of those, you still can function. You're not completely homebound, and you can kind of have some choice in how you live your life. And that policy can come in along with the rest of your plan and supplement that, so that you do get to make some decisions, and you're kind of keeping your dignity, so to speak. And
look, clearly, when we think about retirement, we've said this in workshops before, Scott, and I think it's a universal truth. What people want in retirement is dignity and independence. And facilitating dignity and independence when everything is going well is pretty easy. You create your retirement income plan, you go have fun, you go do the things you want to do. Facilitating dignity and independence when things are not going well from a health standpoint really does require more firepower than most people have, and be able to cover all the other things that they need and want to do. That's why we are adamant about this issue of long-term care. And I think that as you look at it, you have to think about what I call a complete holistic strategy for your finances. And holistic means that we're going to look at not just deal with the things that are going to be fun and good things and all of that. We're going to deal with the things that you probably don't really want to think about, but at some point in time, you will be very glad that you did think about it because you anticipated that problem before it happened and you're prepared to cover it.
So we mentioned a little bit ago in the show about the who, what, when, where, and how of long-term care. We covered the who when we talked about 50% of older adults that will need the care at some point, and the odds shoot up to 70% for adults over 65. We talked about the what, in other words, how do you approach it? What is it that we're talking about? And we talked about the three silos of people and how they will need to address it. If you have little or no assets, Medicaid may be the only option. If you are what we would call a constrained investor, in other words, you've got just enough assets to really produce a favorable retirement income plan for yourself and maybe your spouse, but if there is an event that requires care that could really blow up your plan, that's when we need to leverage an insurance policy, or at least look towards that as an option. And then there are the folks who have overfunded retirement. Their retirement income needs and desires will be fulfilled with a portion of their assets, or even the majority of their assets. We can position what we would call a long-term care bucket over on the sidelines to invest in a moderate way over time to be there for them to be able to self-fund a long-term care event. We talked about the where, that it can be stay out of the nursing home insurance. You can stay at home. We kind of vetted that out. We talked about the how, and that's planning holistically with a specific retirement income monthly on paper, on purpose, so that you can layer that in if there is a need to pay a premium for long-term care. Let's talk about the when. That's the one we haven't talked about. When do you approach this? When is the best time to determine if you need to leverage long-term care insurance? Tony, you want to take that one?
Yeah. So, I mean, it isn't, either if you went the traditional versus the life insurance route, one of the key factors is, your money's going to pay the premium, but your health is what actually buys the policy.
Right.
So, typically look in the, 50, 55, 60 range, but if you have a history of health issues that could be developed, then you want to, we may have to look at it earlier so that we can get you approved for the policy.
Yeah.
Because that's going to be the most important part. We can, want it for you all we want, but if you can't get approved, then there's not a lot of
there's not a lot of leeway there.
Yeah.
And the other thing that you got to think about in this, guys, is that if you buy it younger, your premium is cheaper.
Yeah.
Now, yes, you will pay for it for a longer time, but if you add that up, there's probably a break-even point at some spot in there, but I think that that's really beside the point. What you want to be sure that you are able to do is to get qualified for coverage, because as Tony said, yes, it's your health that buys the policy for you. You qualify based on what your health is like. And it's just like anything else. You can't go buy, homeowners insurance after the tornado has hit the house.
Right.
You've got to buy it before it hits the house for it to be able to pay off. Same thing here. You've got to be able to qualify for that long-term care coverage. So going ahead and thinking about having that conversation way before you have any health problems that might trigger a need for long-term care at now or in the future really is important, because, Scott, they do a fairly in-depth health look at where you are health-wise. But one thing I want to be sure that people are cognizant of is that there is also a cognitive test that goes on as part of the screening for long-term care, because Alzheimer's and mental issues have been really more prevalent these days and are costing insurance companies a lot of money.
Yeah, and that's something that not only is it more prevalent, it's happening at a younger age. I mean, I can tell you from personal experience in the client meeting room, I have a client, a couple who are about to retire, and the main reason that the male spouse wants to retire is because his wife has early onset dementia, and it's leading into Alzheimer's at a rapid pace, and she's only 59 years old. And we know of people in their 50s who develop this and are going to need care. So there is a way to highlight there a need to maybe think about it before that sweet spot that we call between 55 and 60. However, I think there's also a way to approach that. I think it's fair to say that if you have margin in your life at an earlier age, let's say I'm 49 years old, so let's put myself into this. If I have some margin in my life and I'm not in that sweet spot yet, I may worry about qualifying for care, so I'm thinking about that. You can also begin to build your long-term care bucket because statistically, I've got 20 years or so that I'm going to need, or I'm going to have before I'll need this care. You can build up some investable money that would help you self-insure too. So there's an option for you too. But again, we don't know that answer until we put everything together.
Yeah, and I think that it really does. It really is a big emphasis for you to go see a financial advisor, because you can reason your way through to almost any conclusion. You literally can come up with a scenario that makes sense. But really what makes better sense for you is to have someone objectively look at the facts. And that's really where we come along here at Gen Wealth, is that you've got a third party that can sit down with you and your spouse and talk through, okay, let's think about the most likely scenario. Chances are we can't cover every scenario, but maybe we can cover the most likely scenario where one or both of you have a need for long-term care. And so as you walk through that process, there are policies that cover individuals. There are policies that cover jointly that both husband and wife in a long-term care setting. So there are options out there for you. Crafting those options and customizing those options to your situation, to your particular need, is really what our advisors and Tony, as our insurance specialist, do here at Gen Wealth. I think back to, what was it, Hillary Clinton's book, It Takes a Village. When it comes to finances, it takes a team.
Yeah.
And I think that it really does take someone who specializes in insurance, someone who specializes in financial planning, someone who specializes in investments, all three of those mindsets coming together to allow for the opportunity to craft a plan that works for an individual.
Also under the how, and I want to kind of swing this back to you, Tony. We've got about a minute left before our final thoughts. Let's talk about the process. How is that going to work for a client?
Well, the life insurance one is going to be, an application questionnaire. They're going to, dig into your medical history like they would for matches a life insurance policy. May have to do a paramed exam where they just, take some blood pressure, and then there is going to be the cognitive piece added to it. So it'll match, just like if you've done a life insurance exam with that cognitive piece added onto it.
Is that a phone call, the cognitive exam?
Yes. And I've had some people that, thought they understood that part of it, and when we got to that, they backed out because I think they, just got a little nervous. But it's, it's just a necessary part of the process and that's where we want to get on it early. If you wait, too long, then that can be something that can disqualify you.
And there's no cost to go through that underwriting process.
there's no commitment. If they come back and the premium is not what we thought it would be, or it's not going to fit within your budget, then that's something that you're not committed to at all.
Perfect.
How do you do that?
Right up to the bell. That is our final thoughts bell, so it's time to start there. And Tony, I don't even know if we've told you about how this works, but we turn to you for the final thoughts. Do you have any final thoughts or kind of what we've been talking about today?
I would say the long-term care is, a necessity, and an insurance person can sell you any policy, but I think without knowing the financial picture, I can sell you a great policy, but it may not be the best policy for you.
Scott, I would say that financial independence is the freedom to choose to spend your life how you want to spend it. Now, obviously, we're not in total control of that because obviously health issues crop up and anything can happen. But to be able to accommodate that, to be able to deal with that in a way that preserves your dignity and your independence is very critical. We here at Gen Wealth are here to help you through that process, to look at this objectively and say, okay, this looks like the best path for you to take care of this. And if you can take care of it on your own, we'll tell you that. But if you need the assistance of a long-term care instrument to come alongside you to basically defend the integrity of your retirement savings and your legacy to your children, then that's certainly something that we want to help you do. So reach out to us and let's have that conversation.
Yeah, the Ready to Retire process here at Gen Wealth focuses on 7 key areas: creating a written plan, maximizing Social Security, maybe considering a hybrid retirement, protecting against inflation, which is very prevalent right now, securing guaranteed lifetime income, planning for long-term care, and defending against taxes. If you're ready to take the next step, we would give you a phone number to call, 866-653-PLAN. That's 866-653-7526 to begin the first step in walking through the ready-to-retire process at GenWealth. And that's all the time we have for this week's show. We hope you have enjoyed the who, what, when, where, and how. I just thought of that on the fly, by the way.
How about that?
Of long-term care. Hope it was valuable information. We hope you'll join us again next week.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.